Hey, Archie, I've been hearing about tax torpedoes. Is this something retirees should be worried about?
Well, Rob, great question. Let's blow that up. I'm Archie Hoxton.
And I'm Rob Hoxton.
And this is Last Paycheck, weekly wisdom to help you retire and stay that way. Welcome back to the Last Paycheck Podcast. We're your hosts, Archie Hoxton and Rob Hoxton. And today we're talking about tax torpedoes.
Whoa, that sounds pretty serious.
Yeah.
Is this specifically for retirees, or is this just in general?
It's really a retiree problem. And there's a reason they give it kind of a scary name, because I think a lot of people, when they think about taxes in retirement, they're like, well, I'm probably going to pay less in taxes. My income's going to virtually go away. Tax situation will probably be a lot simpler than it is when I'm working. But that's not always the case. And in fact, it does require some planning and some finesse to make sure you don't torpedo yourself.
So I love the imagery of torpedo. When I was a kid, I used to love to watch those World War II movies and the U-boats and I think of, when I think of a torpedo, I picture you're on this, vessel in the middle of the ocean, and all of a sudden there's a little periscope that comes up and everybody scrambles and the siren goes off, and then there's a fish in the water, right? A torpedo coming at you. And you only have a few things that you can do to evade that. And if you don't, you're sunk.
Right.
So when you say tax torpedoes, is this something that's like a really impactful thing?
It can be very impactful. And for many people, it is like a torpedo. It's under the surface. You don't necessarily see it coming.
I can picture you just paddling along, enjoying, retirement, doing a little fishing, and all of a sudden, boom. Jeez, there it comes.
Yeah.
So what is one of the big torpedoes that people who are retired really need to be aware of?
Yeah, so the term originally comes from a phenomenon with Social Security, when you start taking your Social Security benefit. And it has to do with the way Social Security is taxed. It's a unique and complicated tax. And I'm not going to get into the details and into the weeds on it. I'm going to go high level. This is really about just talking about the concept, and how it can torpedo your tax situation. It can really quickly launch you into paying a lot more taxes than you expected. So
here's the thing. This just drives me crazy, and I know that there are people watching and thinking the exact same thing. So my entire working life, I have paid in to this benefit, Social Security, retirement income, right? And my employer is paid in as well. If you're self-employed, you paid both of them.
Mm-hmm.
And so that was a tax that went toward my future retirement benefit. And now I finally am going to get it. And what's the government going to do? They're going to tax it again.
Yeah.
What a ripoff.
Yeah.
Anyway, I shouldn't go there. Sorry.
Yeah. Well, there's a lot of opinions on that.
Yeah.
I think most people would agree that seems crazy. How is that not double taxation? But I mean,
there are lots of examples. There are lots of
conversation.
Examples of double taxation, of course, in the tax.
Yeah. So with Social Security, there is one benefit to its taxation, in that it is never fully taxable. It's only taxable up to 85% of the benefit. Now, that doesn't mean that if your income is high enough that they'll take 85% of your benefit and call it the tax on it. It means that up to 85% of your total Social Security benefit can be included in your taxable income. And then the tax, your effective tax rate would, be pulled from that. And part of it isn't included in taxable income at all.
So maybe at a high level, Archie, if you could just sort of break it down for us. Of course, everyone needs to talk to their tax advisor, right? To see how it applies to you, if it applies to you. It probably does to a degree. But could you just sort of break down the way it's structured at a high level?
So what happens is you take your income from other sources, combined income, and they look at what that amount is, and then they take 50% of your Social Security benefit and they stack it on top. And they call that your provisional income. And then if those two together are over certain thresholds, they will then pull additional amounts from your Social Security benefit into your provisional income to be taxed.
Into the calculation.
Into the formula. And they will continue doing that until 85% of your Social Security benefit is included in this provisional income. So, what does that mean, and why is that tricky? What it means is that, say you have higher income in those combined income sources. Maybe you have a bump, right? Maybe that bump is an IRA distribution. You pull out money out of an IRA to buy a car, right? All of a sudden, they will pull more Social Security in it. Not only are you going to pay more in taxes because of that IRA distribution, they'll also pull more of your Social Security benefit into your provisional income, meaning there's a double whammy effect.
So let me get this right. So let's say you're newly retired.
Mm-hmm.
You got a lot more time on your hands. You're able to pursue some of these hobbies that you've wanted to pursue. Maybe you want to take a nice vacation.
Mm-hmm.
Woohoo, we're retired. Let's go on a really nice cruise. Maybe you've been fishing off the pier for all these years. Now it's time to get that boat. And you take a little more than you normally would from your IRA. Suddenly, that boat is a lot more expensive because not only does that additional IRA distribution cost you more in taxes, but it also increases the rate at which your Social Security is taxed.
Right.
And it's a cascading effect.
Right, it is.
Yeah.
They pull more of that benefit in, which is also taxed. So, yeah, it's tricky because it's complicated. It's a little hard to wrap your mind around at first. And you end up with a situation where something that seems like you would know the impact. I'm pulling $20,000 out of my IRA. I know that's $20,000 of additional taxable income. You don't consider it's a lot more than $20,000.
Right.
Potentially.
I know, Archie, in our practice, if a client says, hey, I need $20,000 for that boat, and I want to take it from the IRA, well, we'll typically withhold money to pay the income tax. Right. So we're going to withhold, maybe 20%, 25% to go to federal, and then depending upon the state in which they live, here in West Virginia, we're going to pull probably 5% and send that to the state taxing authority. But we're probably not we wouldn't necessarily consider the fact that the amount of tax that they owe on their Social Security benefit may be higher.
Right. And that's because this isn't something that is widely known. Your tax advisor or financial advisor will probably know about it. But it's a pitfall that many people fall into, and it's important to avoid. The next question is always, how do you actually avoid it?
Is there anything you can do?
Well, it's all about planning ahead. The first type of planning ahead that I would say is most important, now, and generally you need the most time, is having multiple tax buckets when you go into retirement. And what I mean by that is you've got your IRA or 401k. That's your pre-tax bucket. That's money, you pull it out, you're paying tax on every dollar you pull out. Then there's the opposite of that is your tax-free bucket, right? Think Roth IRA or Roth 401k, where every dollar you pull out, it's not going to be taxed. And then there's your taxable account, or your just sort of general investment account. In that case, part of it's going to be taxed if you're earning interest, you'll pay interest in the year you earn it. If you sell investments at a gain, you'll pay tax on the gain, but not on the purchase price. So it's sort of a mixed bag. It's partially taxable. And then, ideally, the triple tax-free bucket, the HSA,
Oh, yeah.
which goes towards your medical expenses, and if you're over 65, it works like an IRA.
Check out our episode on HSAs if you want some more information on that.
Yeah, definitely. They're an amazing, powerful tool. I would say that's kind of a full lineup of tax buckets that you can use to your advantage.
You could move to a tax-friendly state. That would reduce the rate at which you get taxed. I mean, there are some states, Florida doesn't have income tax.
Right.
You have other taxes that are higher potentially, but you don't have an income tax. Tennessee's a tax-friendly state. There are others as well.
Right.
But there is another torpedo. So there you are. You're out on the lake. You're fishing and having a nice day, eating that bologna sandwich. When all of a sudden the U-boat fires the torpedo, you dodge that one, but bam, from the other side comes the IRMA torpedo. Talk about that.
Yeah. So IRMA it has to do with your Medicare premiums for Part B and Part D. It stands for income-related monthly adjustment amounts. So if you're enrolled in Medicare, you have Part D, and you'll likely also have Part B and Part D, and you actually pay premiums for that. And everybody has a base premium amount. And that base premium amount can be adjusted if your income is high enough. And they publish brackets every year, just like for the ordinary income tax brackets. But you've got these brackets, and if you bump into it, your premium is adjusted, by a certain amount that's determined by the bracket itself. And there's a 2-year look back. So if your income is bumped up, say again that IRA distribution, you might not realize that this would happen, but you take the $20,000 out and you buy the boat. Well, now you've got the problem of now my Medicare premiums are higher, and they may be higher for an extended period.
And this premiums, I mean, if you're a married couple, both on Medicare, you could have premiums that are roughly $300 a month for Part B and Part D, or it could be as much as like $1,100 or $1,200 a month,
right, for
a married couple. So I mean, the stakes are pretty high.
Right.
You multiply that out over 12 months, and you've got some serious cash flow.
Yeah. And then you can imagine how these two things together, if they both happen, you could be paying quite a bit more towards essentially taxes and Medicare than you expected. And so, and once it happens, these things are out of your control. That's why you got to plan ahead for them. And again, another way to deal with the IRMA, the best strategy is, again, multiple tax buckets. So that, picture this. I've got multiple tax buckets. I know I want to enroll in Medicare and say I'm going to do Social Security in the same year, right? Maybe I'm 65 and I want to take both in the same year. Well, then I don't necessarily want to just go and take all of my other income out of my IRA. Maybe I want to mix up IRA and taxable account, or IRA and Roth IRA, or taxable and Roth IRA.
Use your HSA.
HSA,
yeah. So
you can use a blend of income sources and manage your taxes in a way that doesn't draw more Social Security into your provisional income or boost up your Medicare premiums. Now that way requires some advanced planning ahead.
Right, and a lot of people talk about, why do I need a financial advisor? All they're going to do is put my investments in investments that I could buy and collect a fee. Well, a good financial advisor is going to be more comprehensive, and they're going to get involved at this level,
right?
And they're going to be able to demonstrate the value in real dollar terms on an annual basis. So here's an example of how a really great fiduciary advisor earns their keep.
Right. Hey, if you are enrolling in Social Security this year, I noticed you're taking most of your income from your IRA. Say you've delayed Social Security past the point of retirement, and you're taking $40,000 out of your IRA. It's $40,000 in income. let's say you get $20,000 from Social Security. Well, you reduce the benefit, you reduce your IRA distributions by $20,000, get your $20,000 in Social Security. You still are netting out the same, but you've got a much more tax friendly way.
You're grossing out the same.
You're grossing,
but
out
on a
the
net
same.
basis, you're in better shape because you're not paying as much in taxes.
Right.
Yeah.
Right.
I gotcha.
So these, another strategy might be, hey, I know I want to take Social Security. I'm going to delay until age 70. I'm 62 and I'm retired. I don't have anything but my 401k. I would like to create another tax bucket so when that time comes, I've got more control. So I do Roth conversions and get some money out of my pre-tax bucket into my after-tax bucket and let it grow.
Into your never tax bucket.
Into your never tax bucket.
Yeah.
And then, not only that, you're also reducing the future required minimum distribution. So with these planning strategies, you can avoid these tax torpedoes and potentially find other valuable benefits along the way. So I'd say that's probably about all we can cover with today's time. It might even be worth doing another episode on this at some point. It's such a hefty topic, but we hope this gets you thinking about planning ahead and avoiding the torpedoes. And if you enjoyed it, remember to subscribe and share with your family and friends. Give us a like and comment with any questions or future topics you'd like to hear about. Anyway, that's all for now, so thanks again. You've been watching Last Paycheck, weekly wisdom to help you retire and stay that way. If you like this show, be sure to hit like and subscribe. Last Paycheck is available anywhere you get your podcasts.